How Trump's tariffs secretly drain your wallet and crash your investments. Ever walked down a grocery store aisle and wondered why everything seems a little more expensive? Or maybe you've noticed gas prices creeping up, or the price of that new phone you want is higher than expected? You might think tariffs only affect billion-dollar companies, but the real hit is closer to home. A tariff is essentially a tax on goods imported from another country. Think of it like a club entry fee, Anis. If you want to bring something in from another country, you have to pay a fee. Historically, tariffs have been used to protect local industries by making imported goods more expensive. During the Trump administration, tariffs became a major topic of discussion. The administration significantly increased tariffs on goods from various countries, particularly China. The stated goals were to level the playing field, encourage American manufacturing, and bring back jobs to the US. But did it work? Imagine a domino effect. It starts with a tariff on a specific good, like steel. Steel is used in countless products, from cars and appliances to smartphones and buildings. When the price of steel goes up due to tariffs, it increases the cost for companies that use steel. These companies don't just absorb the increased costs, they pass them on to consumers in the form of higher prices. So that new car, refrigerator, or even your groceries, due to transportation costs, becomes more expensive. This is the domino effect in action. Tariffs don't just affect manufactured goods, they also impact commodities like oil and gold. These commodities are traded globally, and tariffs can disrupt the delicate balance of supply and demand. When tariffs are imposed, it can lead to price fluctuations in these essential resources. Think of it this way. If a country imposes a tariff on oil imports, it reduces the demand for oil from that country. This can lead to a surplus of oil on the global market, potentially driving down prices. Conversely, if tariffs restrict supply, prices can rise. As a beginner investor, it's crucial to understand how tariffs can impact your investments. When companies face higher costs due to tariffs, their profits can shrink. This can lead to a decline in their stock prices, affecting your portfolio. Tariffs also create uncertainty and volatility in the market. This volatility can be scary, but it also presents opportunities for savvy investors. However, it's essential to understand the risks involved before making any investment decisions. So, what can you do to protect your investments and make informed decisions? The first step is to stay informed. Monitor news about trade negotiations and tariff announcements. Pay attention to financial news and sector-specific impacts. Following economic news weekly, not just meme stocks, is crucial. React, don't overreact. Drops can create buying opportunities. Spot that early? You just outplayed half the market. Think of the economy like a balloon. If you inflate it too much in one area, it can put pressure on other areas and potentially cause it to burst. Tariffs can create this kind of pressure, leading to unintended consequences. The key takeaway is that tariffs have a ripple effect. They impact everything from the prices you pay at the store to the performance of your investments. Understanding these hidden costs is essential for making informed investment decisions. Have you noticed price increases on everyday items? Are you concerned about the impact of tariffs on your investments? Let us know in the comments below. We'd love to hear your thoughts and answer any questions you may have. If you found this video helpful, please give it a like and subscribe to our channel for more beginner-friendly investment content. We're here to help you navigate the world of investing and make smart financial decisions. Thanks for watching, and we'll see you in the next video.